The 4 buckets of tax classification are an important concept to consider in financial planning. These buckets help you understand how different types of income are taxed, which is crucial when planning for retirement or optimizing your investments. It's essential to understand why knowing the tax implications of each bucket matters when you're planning for retirement or making investment decisions. The tax treatment of your income can significantly affect your net returns and retirement security.
We have taxable bucket. That's paycheck bucket. You earn money, you have to pay tax on it. Then we have tax deferred. That's when you earn your paycheck and in your employer, maybe sometimes, or maybe you go down to the bank, you buy an IRA or you get a 401k with your employer, you can put the money into your account before taxes. That's where you're deferring the taxes. You're going to have to pay the taxes down the road. The big problem I have here is, yes, you get a nice little deferral. You don't have to pay tax on whatever money you put in an IRA or 401k at that time. But when you take the money out, not only do you have to pay tax on what you put into the 401k or IRA, you also have to pay tax on the gain. That's an invisible tax, and that's a tax time bomb, because we have no idea. If you have a great gain, you have a great amount of taxes. That's not fun, is it? So those are the 2 buckets here when we talk about paycheck. Then we have a tax-free bucket. That's if your employer, a lot of times, they'll offer you a Roth IRA option. So the Roth IRA, you can put the money into Roth, but you can't deduct it from your tax return. In other words, if you put $3,000 into a regular IRA, you could deduct your taxable income by $3,000. So $60,000 salary down to $57,000 salary for tax purposes. But if you put that money in a Roth, the $60,000 salary, you still owe $60,000. You still have to pay tax on $60,000. But the beauty of the Roth is now it builds and builds and builds, and when you take the money out, you don't pay tax on any of it. Not the money you put in and not the gain. So big thing. So putting money into that Roth IRA is sort of like being a farmer and you're sitting on your farm one day and you see a big IRS vehicle, one of those black SUVs, you know, the big government employees get out, 4 of them get out with their sunglasses on, look like Will Smith should be a Men in Black kind of guys. And they say, we're from the IRS. We're going to give you an offer that you have to decide today. We're going to honor it forever. We're either going to tax you on the seeds you're putting in the ground today, and we're never going to come back at harvest time. Year after year, we're not going to appear. We're never going to tax you on the harvest. Or we'll leave you alone today. Matter of fact, we'll give you a break today. We're not going to tax you on the seeds, but we're going to come back every year at harvest time, and we're going to tax you on everything you've gained from that harvest. Which choice would you do? The Roth IRA. You pay the guys one time, you pay the tax, you never have to see them again. Now, those are the 3 tax qualifications. And then we have tax-free times 2. That's utilizing the life insurance industry, who has special provisions built into the IRS code to give you tax-free income, tax-free death benefit, and in many cases, tax-free long-term care payments. That's a life insurance policy. Specialized life insurance is not, they're not all the same, folks. So if you have a current life insurance policy, get that reviewed to make sure you have that tax-free times 2 that has those 3 main benefits: tax-free income, tax-free death, but most importantly, tax-free long-term care. You can use some of your death benefit. Let's say you have a $1 million policy and you have to go to a nursing home. You need $80,000. You call the life insurance company, say, I'd like to take $80,000 out of my $1 million death benefit. Please send it to me. Don't tax it because it's tax-free, and I'm going to use that to pay for my nursing home. Folks, you don't need a long-term care policy anymore if you have these specialized tax-free times 2 accounts. Learn about it, if nothing else.
You and your financial advisor should be exploring how diversifying across these 4 tax buckets can impact your overall financial strategy. Spreading your assets among different tax treatments can help manage risk and potentially improve your long-term outcomes.
Knowing the 4 tax buckets is important. Diversifying amongst them, using them in other words, very important. So we're all going to have to pay taxes. So we're going to use that tax bucket. Some money's going to have to pay tax on it. You want to pay tax because you don't want to end up in tax court or tax jail. All right. So then the IRA option will help you build up an IRA. That's a retirement account. So that's money for your retirement. Now, the Roth option there, the tax-free Roth option, gives you a tax-free retirement income to go along with your taxable income. Now, we help people. This is called tax harvesting. We decide where to take the money out in retirement to have the less taxable options for you. So you're going to have to pay tax. And then we say, well, gosh, you just retired. You've got this great amount in your IRA. We can give you a monthly or yearly income from this IRA. The only problem is you're going to pay tax on it, but we could go over to the Roth account and we can start taking money out of that account and not pay tax. But the dilemma is, maybe we should leave that account alone and let it continue to build, because it's building tax-free. The IRS wants you to take money out of the Roth as soon as possible. Now, the tax-free times 2, which is life insurance, what that does is helps you with your overall estate plan and your legacy plan and your long-term care plan. So all these 4 buckets together give you the total financial plan and keeps retirement worry-free forever, not only for you, but your spouse and your next of kin who will inherit a tax-free windfall. You've had a great life. Your goal was to make sure your kids and grandkids were fine after you. You did, but you wanted to make sure you had a great life, so we call it a spend and leave plan. You start with a certain amount of money in a lump sum in all these 4 accounts, and the goal is for you to have a great life and your spouse to have a great life, but when you pass away, an amount equal to or greater than you started with will pass on to your children and grandchildren tax-free. That's using true diversification, not only in the market, but in the tax code.
Understanding these tax buckets is a key element in crafting a smart, tax-efficient strategy for your retirement and investments. If you're looking for tailored advice on managing your tax strategy and enhancing your financial plan, our team is here to help. Coach Pete and the team at Capital Financial are ready to offer tips and strategies to get you where you want to be in retirement. Take advantage of the no-cost, no-obligation financial review to understand the ins and outs of your retirement plan. A customized plan based on your wants and needs. Contact us today. Also, be sure to like this video and subscribe to this channel for more retirement help.